Bitcoin just did something it hasn't done in 847 days. The price broke through a critical resistance level that historically signals the start of massive bull runs. And what happens next could change everything for small investors like you. Because here's the truth most people don't realize: you don't need thousands of dollars to make life-changing gains in crypto. In fact, starting with just $100 might actually be your biggest advantage. Why starting small is actually better. Here's something that might surprise you. Professional traders often say the best education in crypto costs exactly $100. Why? Because when you're trading with money you can actually afford to lose, you make better decisions. You're not panicking at every 5% drop. You're not selling at the bottom because you're worried about rent money. Instead, you're learning, testing strategies, and building the discipline that separates winners from losers in this market. The psychology of trading small amounts is completely different. You're in what I call the learning zone, that sweet spot where you have real skin in the game, but not so much that fear controls your decisions. This is where you develop the iron discipline that will serve you when you're trading with $10,000, $100,000, or more. The numbers don't lie. Research shows that 95% of traders who start with large amounts lose money in their first year. But those who start small and build up, they have a 68% success rate. The average time to turn $100 into $1,000 is 6 months with proper strategy. And once you hit $1,000, reaching $10,000 takes just 4 more months because of compounding effects. Step 1. Risk Management Rules. The non-negotiable rules that protect your capital. Never risk more than 5% of your portfolio on a single trade. That means with $100, you're risking maximum $5 per trade. Use stop losses on every single trade without exception. Your stop loss should be 2-3% below your entry price. Take profits at predetermined levels and stick to them. Emotion is the enemy. Maintain a 2-to-1 reward-to-risk ratio minimum. If risking $5, aim for $10 plus profit. Keep 20% of your portfolio in stable coins for opportunities. Track every trade in a journal including entry, exit, and reasoning. These rules sound simple, but they're the difference between still being in the game 6 months from now versus being another cautionary tale. I've seen traders turn $100 into $5,000 and then lose it all in 1 week because they abandoned these principles. The market will test your discipline constantly. Stick to the rules even when it feels painful. Step 2. Identifying high-potential altcoins. The biggest gains in crypto don't come from Bitcoin, they come from altcoins that nobody's talking about yet. I'm talking about projects with real utility, strong teams, and communities that are genuinely excited. Here's how to find them before they explode. Look for projects solving real problems in areas like DeFi, gaming, or data storage. Check if the team is doxed and has a track record of shipping products. Analyze the tokenomics. Low circulating supply with high total supply means more upside. Join their Discord and Telegram. Active, helpful communities indicate strong projects. Social signals are crucial but often misunderstood. You're not looking for hype, you're looking for genuine engagement. Does the project have developers answering technical questions? Are community members creating tutorials and content without being paid? Is the trading volume organic or wash trading? These details separate real gems from pump-and-dump schemes. Step 3. Entry and exit strategies. Timing isn't everything, but it's close. The difference between buying at $1.85 might not seem like much, but that's a 17% head start on your gains. And in crypto, that 17% compounds fast. For entries, use technical analysis basics, support levels, moving averages, and RSI indicators. Wait for confirmation, not speculation. For exits, this is where most people fail. Set your targets before you enter the trade. I use a tiered approach: sell 25% at 2x, 25% at 5x, 25% at 10x, and let 25% ride for potential moonshots. Here's a simple script that helps automate your exit strategy. This Python code monitors your positions and sends alerts when they hit your predetermined profit targets. It uses the Binance API to track prices in real time and calculates your position sizes. The script checks your entry price, current price, and profit percentage every 60 seconds. When a target is hit, it sends you a notification so you can execute your tiered exit plan. You can customize the profit_targets list to match your strategy. Python script for automated crypto exit strategy monitoring. Uses CCXT library to connect to Binance Exchange API. The positions dictionary stores entry prices and quantities for each trading pair like BTC/USDT and ETH/USDT. The profit_targets list defines percentage gain milestones at 100%, 400%, and 900% representing 2x, 5x, and 10x returns. The check_positions function iterates through each position, fetches current market price via fetch_ticker, calculates profit percentage by comparing current price to entry price, and checks if any profit target has been reached. When a target is hit, it prints an alert suggesting to sell 25% of the position at the current price, and marks that target as hit to avoid duplicate notifications. The main loop runs check_positions every 60 seconds for continuous monitoring. This enables disciplined tiered profit-taking without emotional decision-making. Step 4. The compounding formula. Position sizing is where the magic of compounding happens. Most beginners make equal-sized bets on everything. That's wrong. You should be allocating more capital to high-conviction trades and less to speculative plays. Here's the breakdown of an optimal $100 portfolio allocation for maximum growth potential while managing risk effectively. As your portfolio grows, maintain these ratios but increase position sizes proportionally. When you hit $500, that 35% in high-conviction alts becomes $175, enough to split across 3-4 quality projects instead of just one. This is how you reduce risk while maximizing upside. The key insight: your stablecoin reserve grows too, giving you bigger opportunities to capitalize on market dips. By the time you reach $2,000, you have $300 in dry powder ready to deploy when everyone else is panicking. The difference between random allocation and strategic position sizing is dramatic. One approach treats every trade the same regardless of conviction or risk. The other maximizes returns while protecting capital. Which trader would you rather be? The 7 deadly mistakes that kill portfolios. FOMO buying at the top is the #1 portfolio killer. You see a coin pumping 50% in a day, everyone's talking about it, and you convince yourself you need to get in now. But here's the brutal truth: by the time you hear about it, you're exit liquidity for early buyers. They're taking profits while you're buying their bags. Instead, put interesting coins on a watch list and wait for pullbacks. Patient traders make money from impatient ones. Revenge trading after a loss is deadly. You lose $20 on a bad trade, get emotional, and immediately jump into another trade trying to make it back. This almost always leads to bigger losses. The solution? Take a mandatory 24-hour break after any losing trade. Use that time to journal what went wrong and review your strategy. Losses are tuition in this market, make sure you learn the lesson. Ignoring gas fees and transaction costs seems minor but kills small accounts. You're paying $515 per Ethereum transaction. Do that 10 times and you've burned through $50150 of your $100 starting capital. The fix: batch your transactions, use layer 2 solutions like Arbitrum or Optimism, and consider exchanges with lower fees like Binance or KuCoin for trading. Every dollar saved on fees is a dollar that can compound. Falling for influencer shills is expensive education. That crypto YouTuber with 100K subscribers gets paid $5,000 to promote a dead project. By the time you buy, the paid promotion is done and the price dumps. Red flags include vague promises of massive gains, emphasis on getting in early before it's too late, and no discussion of risks or tokenomics. Do your own research always. If they're pushing urgency, it's usually a red flag. Overleveraging destroys accounts instantly. Trading with 10x or 20x leverage means a 5% move against you wipes out your entire position. Leverage amplifies both gains and losses. With a $100 account, you should never use more than 2x leverage, and honestly, no leverage is even better while you're learning. Build your skills with spot trading first. Leverage is a tool for experienced traders, not beginners. Not taking profits is the silent killer. You watch your $100 turn into $500, then $1,000, and you think it'll keep going forever. Spoiler, it won't. Markets correct. Always. Take profits at predetermined levels using the tiered approach we discussed. Yes, you might sell some and watch it keep pumping. That's fine, you already won. Pigs get fat, hogs get slaughtered. Be the pig. The deadliest mistake of all, not learning from your trades. You make 50 trades but can't remember why you entered most of them or what went right or wrong. Keep a trading journal. Record entry price, exit price, profit or loss, your reasoning, and what you learned. Review it monthly. The patterns that emerge will be your roadmap to consistent profitability. Successful traders aren't lucky, they're students of their own performance. Step 5. Setting realistic expectations. Let's get real about the timeline. This isn't a get-rich-quick scheme, it's a systematic approach to building wealth. Here's what a realistic journey from $100 to $10,000 actually looks like when you follow the strategy properly and maintain discipline. Average time, 12 months with consistent strategy alarm clock. Notice this timeline assumes consistent execution and normal market conditions. During a bull market, this could happen in 6-8 months. During a bear market or sideways chop, it might take 18 months. The key is staying in the game and not blowing up your account. Some months you'll gain 50%, others you'll lose 10%. That's crypto. The strategy works over time, not day to day. Surviving market crashes. Market crashes will happen. Bitcoin will drop 30% in a week. Your altcoins will drop 50%. This is guaranteed. The question isn't if, it's when and how you'll respond. Winners use crashes to accumulate. Losers panic sell at the bottom. Your stablecoin reserve is your weapon here. When everything's red and people are capitulating, that's when you deploy 2550% of your reserves into quality projects at discount prices. During the May 2021 crash, Bitcoin dropped from $64,000 to $30,000. Traders who bought at $30,00035,000 and held saw 100% plus gains within 6 months when BTC hit $69,000. The 2022 bear market saw even better opportunities. Those who accumulated quality altcoins at 90% discounts made 5001000% when the market recovered. Crashes aren't disasters, they're wealth transfer events from weak hands to strong hands. Here's your crash survival protocol, 5 steps that keep you calm and profitable when everyone else is losing their minds. Follow these in sequence whenever the market drops more than 20% in a week. Taking it to the next level. Once you've grown your account to $1,000 plus, you unlock advanced strategies that weren't possible at $100. Staking and yield farming become viable. You can earn 520% APY on your holdings. Participating in quality IDOs and pre-sales gives you access to tokens before public listing. Dollar cost averaging into blue chips becomes more impactful. And most importantly, you can now properly diversify across 810 positions instead of just 2-3. Advanced profit optimization strategies. Rotate profits from pumping coins into undervalued projects. Use limit orders to capture volatility while you sleep. Implement trailing stop losses to protect gains on runners. Allocate 10% to high-risk, high-reward moonshots. Join quality alpha groups for early project information. Use portfolio tracking tools like Delta or CoinStats. Set up price alerts on TradingView for key levels. The power of compounding at this stage is remarkable. With a $3,000 portfolio, a 50% gain adds $1,500, already more than your starting capital. A 100% gain at $5,000 means $5,000 profit. This is why protecting your capital and staying in the game matters so much. Each dollar you compound today becomes multiple dollars tomorrow. Psychology of successful trading. Here's what nobody tells you: the strategy is the easy part. The hard part is executing it consistently when your emotions are screaming at you to do the opposite. When Bitcoin dumps 20% and you're down $200, your brain wants to panic sell. When your altcoin pumps 300% and you're up $900, your brain wants to hold forever. Both impulses will cost you money. Successful trading is about following your system even when it feels wrong. Two traders start with the same $100 and the same strategy. One follows the rules religiously. The other makes small emotional deviations, holding losses too long, taking profits too early, revenge trading. After 12 months, the results are drastically different. Build your mental resilience through deliberate practice. Start each trading day by reviewing your rules. End each day by journaling your thoughts and trades. Meditate for 10 minutes before making major decisions. Take breaks from screens and charts. Constant monitoring breeds anxiety. Celebrate small wins to build positive reinforcement. And remember, this is a marathon, not a sprint. From $100 to $10,000, the roadmap. Everything we've covered comes down to execution. You now have the complete blueprint. You understand why starting with $100 is actually an advantage. You know the risk management rules that will keep you alive. You can identify quality altcoins before they explode. You've learned entry and exit strategies that maximize gains. You understand position sizing and portfolio allocation. You know the deadly mistakes to avoid and how to survive crashes. The question isn't whether this works, it's whether you'll actually do it. Here's your week 1 action plan. Do exactly these 5 things in your first 7 days. No shortcuts, no skipping steps. This foundation determines your success. This is not financial advice, it's a strategy that's worked for thousands of traders who started exactly where you are right now. Some will watch this video and do nothing. Others will make excuses about why they can't start. But a small percentage will actually execute. They'll open that exchange account tonight. They'll transfer that $100. They'll make their first trade this week. And 12 months from now, they'll look back at this moment as the turning point. Which group will you be in? The market is waiting. Your $10,000 journey starts with $100 today.